Welcome to the first lesson in the Introduction to Valuations chapter on the basics of valuations.
Before we could go much deeper, we have to define our terms. Valuations are simply dollar values attached to an asset. To be more specific, valuations are ideas about the value of something, not the actual market price. Assume two people are at a farmer's market and are interested in buying the last green apple left in stock. Without seeing the price tag on the apple, the two people likely have different ideas of how much the apple is worth based on a number of factors. They both have their own valuations of the apple. Even the farmer operating the market has a valuation of his final green apple. In general, supply and demand will dictate who ends up buying the apple and at what price. The price the apple is sold for is considered the market price. So we'll talk about this a lot more in detail later, but investment bankers are more concerned with ideas about value, not necessarily the actual value observed in the market. That gets to the core of the term valuation. Before we get in more detail about how these concepts apply to investment banking, let's explore how other types of financial firms use valuations. Hedge funds, for example, often use complicated computer models to determine their own idea of a true value of a stock, for instance. To make money, these funds will look for assets that they believe to be mispriced. In the long term, hedge funds hope that the price of a stock in the market, for example, will reach the stock's theoretical value. This implies that the current market price does not reflect the true value of the company, meaning the stock is mispriced. Take Microsoft, for instance. If a hedge fund's complex computer model calculates the price should be $155 per share, and the actual market price of the stock is $134 per share, the firm could theoretically buy the stock and generate income when the stock's market price approaches the hedge fund's valuation. So, we talked a little bit about private equity firms in previous modules, but PE firms essentially use a partnership structure to raise money and buy businesses with the attempt to sell the businesses for more than they paid for. Since PE firms acquire businesses as part of their core business model, and acquisitions are a key part of investment banking, PE funds and investment banks work together frequently. However, PE funds and investment banks use valuations very differently. PE funds are interested in finding profitable acquisitions to pursue. Investment banks are more concerned with successfully negotiating a deal between a buyer and seller. Since PE funds are designed to profit from selling businesses for a greater price than they paid, they often use much more complex algorithms and financial models to find companies that are likely to increase in value after an acquisition. Some prominent PE funds to become familiar with are Apollo, KKR, and the Carlyle Group. We'll use KKR in a few different examples in future modules, as they're one of the oldest and most versatile PE funds in the industry. Finally, let's discuss how valuations fit into the functions of investment banks. These banks do not use valuations to find mispriced assets, but instead use them as a way to mediate a financial transaction for two parties or businesses. I know this might sound a bit ambiguous, but we'll dive into how these valuations are used in a future chapter when we discuss the functions of investment banks in greater detail. At a high level, investment banks use valuations differently in capital raising versus mergers and acquisitions. In capital raising, investment banks use valuations to help find the right price for a company trying to raise capital. We'll get into detail on this in later modules. For acquisitions, investment banks use valuations in helping to find the right transaction value or final sale price for a company. Think back to our analogy on realtors. The investment bank is responsible for providing an appraisal for a business looking to be sold. As we continue, we'll start to separate from describing the uses of valuations to simply introducing valuation methods. Valuation methods are simple mathematical models that are used to help find a theoretical valuation, or the idea of an asset's value. Throughout the rest of the chapter, we'll go over the basics on the different valuation methods used in investment banking, focusing heavily on developing a solid conceptual understanding. Coming up next, we'll discuss the two main types of valuations and use some examples to help illustrate how they classify specific valuation methods that we'll discuss throughout the chapter.